Over the past 10 to 15 years, it's fair to say that when it comes to financial markets, we've had it fairly easy. In the past 10 years, the earnings of the S&P 500 have roughly doubled, and the price has tripled. The highest federal funds rate we've seen before what's happening right now was just 2.5%, so it's been a good time for businesses and investors. Money has been cheap to access, which has made it easy for businesses to expand, valuations to grow, and investors to make money. At the end of 2019, it seemed like anything you bought was doubling fast, but then of course the bubble burst. The pandemic threw the world into chaos, businesses shut down, and the financial markets collapsed. The recession was long and dark, and the investing world was brought to its knees. Yeah, right. In reality, the central banks of the world stepped in, printed trillions of dollars, gave it to businesses and consumers, and simply kicked the can down the road. But now we've caught up to the can. And with inflation at basically 40-year highs, the game of printing money to save us can no longer work. The Federal Reserve, as we've seen, has now been raising interest rates, sharply restricting citizens' and businesses' ability to access money, thus putting the brakes on the economy. And to put things lightly, it's caused the financial markets a bit of a headache. Cryptocurrencies have been destroyed, real estate is falling, big-name companies are now struggling, and the stock market is looking pretty shaky. Investors are selling up with fears that the deep recession we had to have is now finally here. But despite all that's happened so far and all that will happen over the next year or two, this could be the best time of your entire life to get ahead and build your wealth. So let's talk about why right now is such a big opportunity and how you can use it to your advantage. Some people should not own stocks at all because they get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. There's a lot of psychology in investing, a lot more than people realize. Of course, the simple idea of investing is to buy low and sell high. But in reality, most people do the exact opposite. They buy high and then they sell low. I mean, they don't mean to do this, but when times get tough, the fear, uncertainty, and doubt just scare them out of the market. But as people like Warren Buffett, Charlie Munger, Mohnish Bryant, Guy Spier, Phil Town, and all these others would say, when the market is down heavily, that's the best time to invest. The lower the entry point, the better. Listen to this. We're a net buyer of stocks over time, and who wouldn't rather buy at a lower price than a higher price? People are really strange about that. I mean, like most people, most of your listeners are savers, and they should want the stock market to go down. They should want to buy at a lower price, but they got that feeling that they just feel better when stocks are going up. It's a really interesting phenomenon. The main thing that causes this backward psychology is that most people don't have clear investment goals and they haven't committed themselves to a long-term investing time horizon. So when the news gets bad and the recession hits, instead of seizing this big opportunity, they simply run away from the possibility of short-term pain. But that, in reality, is a terrible strategy. In that time, since 1926, there were 15 recessions and 11 bear markets, 12 if you add in the 2020 drop. The bear markets lasted for 14.7 years total. And to go with that, you have 75.4 years where the market was in a bull run. Think about that. These scary, world-ending events happen very infrequently. And as you can see, if you have the stomach to go against the grain and invest during these periods, you're often very well rewarded. Just take a look at these returns coming out of the Great Depression. You made 265% across 4.4 years. After the next bear market, you made 43% in 1.8 years, 210% in 4.1 years, and 908% across 14.8 years. The trend goes on. I love this chart that Tony Robbins put in his book, Unshakable. If you were the guy or gal that put your money where your mouth was at the lowest point of each of the biggest bear markets in recent history, this is what you would have returned just 12 months later. 20%, 30%, 40%, 50%. Now, while it's impossible to perfectly pick the market bottom, and in reality, you likely won't get exactly those returns, it does show you just how big of an opportunity a bear market can be. For example, if you invested at the peak of the market before the 2020 COVID drop, you would have made about 9% on your money. But if you decided to invest at the market low, which was just a few weeks later, then you would be up around 60%. That's how much of a difference your entry point can make. And remember from the chart before, these big drops are very infrequent. 14.7 years of bear markets and 75.4 years where the market was in a bull run. Think about that. These scary, world-ending events happen very infrequently. And as you can see, if you have the stomach to go against the grain and invest during these periods, you're often very well rewarded. Moments where it is worth enduring some pain for long-term gain are rare, but recessions can be significant opportunities for investors. One way to seize these opportunities without making mistakes is to keep informed about what is happening in the market and to execute your investment strategy correctly. When it comes to investing, there are two main approaches: dollar cost averaging, where investors invest a fixed amount in a market tracking investment at regular intervals, and long-term value investing, as practiced by Warren Buffett. Dollar cost averaging is designed to remove emotion from investing while still allowing investors to benefit from the market's long-term performance, which is around 10% per year for the S&P 500. While it may not seem like this strategy involves timing the market or taking advantage of a stock market crash, it does. When the market is high, a fixed amount of money will buy fewer shares than when the market is low. This means that investors will naturally buy more shares when prices are lower and fewer when prices are higher, without having to change their investing habits. The second approach, long-term value investing, involves identifying undervalued stocks and holding on to them for the long term. This requires more work and knowledge than dollar cost averaging, as investors must research and analyze individual stocks, but it can also potentially provide higher returns. To sum up, recessions can provide opportunities for investors, and keeping informed and executing a sound investment strategy is key to taking advantage of these opportunities without making mistakes. There are two main approaches to investing: dollar cost averaging and long-term value investing. Dollar cost averaging involves investing a fixed amount in a market tracking investment at regular intervals, while long-term value investing involves identifying undervalued stocks and holding on to them for the long term. Thank you very much for watching. Leave a like on the video if you made it all the way through to the end. And with that said, guys, I'll see you all in the next video.